So we are going to study one of the models that we have, and this is from the 07, 08 timeframe. It was Mosaic, and it was very unusual at the time because these, fertilizer stocks had been dead money for years and years, ever since I could remember. But then all of a sudden, Potash, Mosaic, and a few others, CF, had these monster moves. So it's one. The first thing is it's a reminder to ourselves to always have an open mind with industry groups. A lot of us have, myself included, have a bias against a lot of different groups. But if the stocks start acting well, you need to kind of change your mindset and be open to it, and especially if the technicals are there and the fundamentals are there. So this was one of the ones that out of a model book that Charles and I, built for Bill during this period. And you could see where Bill marked this up and what he said to do in there. And that was his approach. I have a different approach, and I think everyone should have a different approach. When you study stocks, you should study them with your own eyes, not the way I walk through it, or anyone else, or Bill. You can use that as information, but really everyone has a unique trading style. And so you need to find that and then find how you can trade stocks. Some stocks you're just not going to make money on. Some other ones you're going to kill it. You have to find the right stock for your personality and your style of the IBD methodology. So this one was a tricky one. We're going to start it off where we're going to switch over to market surge in a second, but we're going to leave this up here. You can see on there, the different points where he was saying not to buy, and where to sell. And you can make your own judgment based on, the comments that he has in there, if that works for you or not. Frankly, they don't work for me, for my style of looking at this. I want to lean on, the way I look at things. There's nothing right or wrong about that. It's just different than, the way he marked it up. And so anyways, the key in on there on the A, B, and C in there early on, that's an ascending base. And then we've got 1, 2, 3 in there, which was 3 waves down. We're going to focus in on that, as well as where to ultimately sell the position. So with that said, let's go toggle over to market surge, and let's just go out to the end of 2008. Just go to December 31st of 2008 on a weekly chart to see what happened after those final markings. I like to, with my models, look and see, years afterwards. It kind of, it really, in fact, just let's start off with a monthly chart here. And, just kind of see what has happened and, what happens afterwards, because it reinforces that when it's time to sell, you want to sell it. So we are going to put in some moving averages. Go to the wrench, go down to the RS line, relative strength line. Okay, and then I'm just pulling mine up to make sure that I tell you the right thing to do, and everyone should be doing this at home. So under the default, we're going to just put these numbers in. On the daily is 21, on the weekly, the weekly an 8, and on the monthly a 10.
Okay.
And everyone at home, make sure that it says index line up there and that it's pointed to the S&P 500. Now let's also do the same thing on the RS line 2. So just add a line up there. Click on that. Okay. Now under symbol group, up on top, let's switch that to index, and it automatically goes over there. Now for your daily, put that at 50 days. Add your weekly, put it at 21, and then for monthly 24, and then apply changes. And so what this does, this is, one of the things I invented over the decades, was putting a moving average onto your RS lines to really smooth things out. And holding a big winner, it's the only way that I know how to do it. And I designed this specifically to fix a flaw of mine, a major flaw of mine, of not being able to hold things, like for a long period of time, because I get wiggled and wobbled out by looking at the price action and the intraday action. So I wanted to design something that would allow me to hold things. And these are referred to as the quicksand, and Grateful Dead rules. Let's go to the weekly, because it will base this segment on that. You can use it on the daily when you're first starting to get going in the trade. the week, and let's say, once you're up 30, 40%, or you've been going for a number of months, then you can toggle over and start using the weekly ones. And it's just very simple. This is a core part of your position is you wait for that green line, which is your RS line, to go underneath your gold line, which is your shorter term moving average. And I call that the quick. And I just got that out of Bill's book, because he has a line in there, my favorite line. There's a quick and the dead. So I'd rather be quick and sell some there. So in our mock portfolio, in our mind, we're going to say our max position is 25% of our portfolio in one stock. That's probably way too much for most people, but just for, to make this easier, that 10%, but you're going to try to hold a core position of 15%. So that means from 15 to 25% of your account, you're going to use other rules, offensive selling rules, defensive selling rules, anything else for those, but you're going to use these quicksand, Grateful Dead rules to hold the rest of it. In each one, as they trigger the quick, you sell 5%. So when it hits the line, you sell 5% of your core position. So you would have a max position at that point, goes from a 15 down to a 10. If it goes below that RS line, in fact, let's just point to it there in the middle of, we'll get to it as we go through. So if that RS line goes lower than its first break of it, that becomes a quicksand, and it's kind of like the frog in the boiling water type of thing where you want to do some more selling. And that brings it down to just, you sell another 5%. Now you have your last 5% until that RS line goes through your blue one. And can you point to that, where that happens on there? Yeah. So right there, that's you're dead. The stock is dead to you. And I decided to call it a Grateful Dead, because I'm a deadhead. And so that's where I throw in the towel. This is what I devise over years and decades of studying models. You don't have to use this, but come up with your own. Study these. This is gold. Using market surge with a change date feature and going through bar by bar will teach you more than any trading book, anything out there, period, you doing it yourself. And so we're just going to quickly go over some of the things that you would do. We're going to start it off where he started it, which was a 9/22/07. No, I'm sorry. February 16th of 07. So let's do a change date there. So this was out of this base. I think that you could have, if you're doing it at home, I would study it out of that cup with handle there, that you had all these bases next to each other, and then you had that cup with handle that ended up working. And it's reminiscent of, and we don't have to go there right now, but of Qualcomm back in the 98 timeframe, where you had base next to base next to base that wasn't working. And then the last one did. And even like Tennessee coal and iron back in like 1890 something, where you have base next to base, where each one just gets a little bit tighter and a little bit tighter. And you can see that cup with handle versus the other ones. So that cup with handle there versus your other bases to the left of it looks so different, right? And it looks so much tighter in each week in there versus the other ones is much better. How deep is that one, that base? Only 20% deep. Yep. That's really nice. How about that double bottom that we had a while ago? What is that one at? Yeah, so 33. So you want your bases, especially when they're side by side, to be getting tighter and tighter. Is a sign of equilibrium that everyone is now, comfortable with that level, until less price discovery is a positive thing, until things change, and hopefully they change for the better. So it changed there, it moved up, and no one was believing it, myself included. I don't think anyone I knew was trading those fertilizers early on. It was, kind of the second move where Bill was saying to start studying it, because, earnings didn't look good. And it was just this weird thing of this, fertilizers. Why are fertilizers working? And there's reasons for it, but we're not going to get into that right now. But look at that breakout. That is a solid breakout. How much is it up that week? 18% for that week, closing up near the highs. That's a monster. But also look within the base. Whenever you're studying models, pay attention to the week by week analysis. This isn't a great base, but there is one thing in there that's really good, and that is your bottom week in there. So you want to pay attention to a few things in a base. Your biggest spread, your biggest volume, if you use volume, the ones that have the biggest price percent change, even if the biggest spread and the biggest price percent change doesn't always happen the same week, and what your bottom week is. And so on that bottom week, what was the closing range on there? It looks like 93%. Like that's beautiful. And look at that volume versus everything else prior. All the volume in the week or in the weeks before that during the base. You look at the volume. I'm just going to talk volume because I know everyone uses it. And when we talk historically, I did used to use volume back there. That's why I'm referring to it. But you pick up on the volume being higher than any other week in the base. That's key. But also versus the prior week. So that's something that Bill would do. Prior week versus what is your couple key ones in there. So this gets you out of the starting gate. Let's look and see what it looks like on a daily. And so kind of a solid breakout, and you don't have to wait for it to go through the 2354, where I would have been buying it is at that 2257, the prior resistance in there. And you can also draw a downtrend line, go from the 2354 to the 2257, make that tangent. Yeah, exactly. That's where you could start buying it. Then when it takes out the 2257, that's when you're pyramiding into it. You're buying a little bit more. And then when it goes through the 2354, you're just juicing it with making it, your full position. Now let's go out at, just go out a couple weeks from here. Just go out to the end of the month. Perfect. So with this is exactly how a stock should break out. It breaks out, it has a little bit of a test, but it holds up above the base. And in this case, it holds up above your 21-day. So it's acting nicely. Let's just go out to the end of June and pay attention to those RS lines versus their moving average. You're trending above it. It's staying above the blue one on there, acting nicely in this ascending base type of feel of each pullback being higher than the prior one. Let's look at it the weekly, and it'll probably give us a better look at that. And on here, it has that feel where it's just, just nice pullbacks, kind of the stair steps that Chris would actually like. He doesn't like stair steppers, but when it's an ascending base, I think he would like that. Now let's just go out to the end of the year and pay attention. Those RS lines are holding up above that moving average on a weekly. You did get one test of it, so there would have been one quick signal in there, but then as quickly as that happened, it moved back up, and so you could be buying those shares back. If you use this strategy, you're going to be wiggled and wobbled out of some of your position. It's not, buy the whole thing all at once and then sell it all at the top. That's unrealistic. So you're varying your size of it, and that's the question you should be asking yourself when you do this. You should go through this 1 week at a time, which we don't have the time to do this morning, but go through it and ask yourself, what signals, buy signals or sell signals, is this week triggering? How are you feeling about it? Actually put it into a portfolio and look at the dollar amount. Is that your dollar gain or your dollar loss or your give back off the highs in dollar terms? And that will get your mind to start working. I do it in percentage terms, but at first want to do it in dollar terms. So it gets you kind of acclimated to the ups and downs of holding a big position along the way, because it's not for everyone, and it's very hard. And so the hardest part in here was that little middle, what Bill had marked as 1, 2, 3 in there, where the sideways terrible looking base on there. But look what happened. Let's do a change date where it moved above 40, like around 41 or so. What week did that happen? And let's go there. Yeah, right there.
Let's see. Yeah, moved above 40, right in this area.
Yeah, let's go there to the August 31st to take a look at that.
All right.
Because this is the hardest part of it. And if you go through it and you go, hey, I would have been kicked out of it, that's realistic, because that was really hard in there. But I'm going to just walk you through how my quicksand rules would have worked. When you went through that moving average, the gold moving average the first time, you bring it back down to a 10% position. When that RS line goes back through it, you can, but you don't have to increase it back up at that point. And so let's just say you increase it back up. You might not want to because it was so sloppy and hard in there. which we'll toggle over to a daily in a second. Let's just toggle to the daily so they see how hard this was. This was a total mess during this time. I mean, all over the place. And you think, this is terrible. But pull up the NASDAQ during that same time. Like everything was really hard, chopping around from memory. I could be wrong. Yeah, look at that. Like what the market is doing is coming in like that, but this is trying to hold up. That's why you always look at both things. Pull up Apple, because that was a big stock back in that time frame. And that, I mean, that's a big move from 148 down to 111 for a big quality stock like that. Now let's go over back to Mosaic and what picture that's telling you. So in isolation, it looks sloppy, but you always want to play three-dimensional chess when you're doing this work and toggle back and forth between what the market's doing. So that RS line was telling you, hey, this wants to go higher. It's just the overall market is the problem. So frankly, I don't know that I would have been able to live through any of that in there. I probably would have bought it and sold it a million times if I was just using how I felt the daily chart looked like. That's why I developed this quicksand Grateful Dead rules on the weekly. Let's go over to that, because you're up enough on this that you would have toggled over to the weekly rules, and you would have at least kept some of that because you didn't get your quicksand or your Grateful Dead signal on it. So you would have had at least a 10% position holding through all that mess using your instruments, not using hindsight, which is a big difference. Now let's go out to the end of the year. Just let's put a 12 there. Now that we have this in our mind. So you had this another launch, because once the market firmed up, it was able to launch out from there. And then this disconnected from what the market was doing. Because now let's pull up the NASDAQ. And because if you remember, on October 31st, that was the peak in the market. So the market was still going up, but then, go to the daily. I'm sorry.
Yep, got it.
That just threw me for a sec. So up there, the 286151, that was your peak, and if I'm not mistaken, that was Halloween. And so then you started this big, terrible bear market, but yet at the same time, Mosaic and Potash and CF were all holding up. Now let's go back to the Mosaic, which if your market rules would have kicked you out of this, that's fine too, because it was really tricky during that time frame. But now let's just go out another 6 months. All right, so it's just base building and moving up. Let's toggle over to the weekly and see how that was looking at this point. And you could see that RS line was testing the gold thing, but it never triggered your Grateful Dead signal of going through your longer term moving average. And this would have been a perfect stock for like the leaderboard team, like you, Ken and Dave and Mike Larkin. Like this is a type, that's perfect for that, not perfect for swing trading. Now let's go out to the end of 08 to see where that where you finally have to throw in the towel. And you see there, it finally rolled over. Let's find the week where it crossed through our Grateful Dead signal. So that's where you have to finally throw in your towel if you're using these rules. Now, maybe your rule was using the 40-week line, which is that black line. Nothing wrong with that. Find your rules. Your rules could also be closing X% below your 10-week line. If that's your rule, nothing wrong with that. Just study it and see where that would have triggered some sell signals along the way that this one didn't. And find when you study historical examples, you really want to, you're studying for the battlefield. It's not just, you're not wasting your time. You're trying to ingrain this in your mind. So when you're in the real battlefield and you've got all these moving parts that are going on, NVIDIA's earnings are coming out overnight, and you've got this going out in the White House, and this is going on overseas, and your favorite company is reporting next week, and all these other things. If you have a firm foundation, you'll have a better chance of getting out alive than if you just wing it, on how you feel. And again, on this one, how I would have felt would have tripped me up the whole way along the way. And it was why I developed these rules. So I challenge everyone to find the rules that work for you. Don't data fit, find the rules, write them down, codify them, and then have them as black and white as possible that a computer could do it. Then take the next stock and see where that didn't work and adjust them. And then the next stock and so on. And so Bill had the way he would do it. He would take a look at this and see where did it start off, study that. What did the fundamentals look like at the time? What did the group look like at the time? What does the base look like? And then he would study, the top and what signals would have gotten you out of there. And so everyone has their different way of doing things. Let's just go out 2 years from here, and then we're going to wrap this up. Just put a 10 there. And this is a reason to not fall in love with a story and argue that you've read the conference call or you watched the conference call and you like it and you like the CEO or whatever the story is. Look, if that stock is going down, have a line in the sand. Let it be the 40-week line, the black line there. Let it be the Grateful Dead line or your own thing. Maybe it's 30% off the highs or 40% off the highs, but have a final line in the sand, because otherwise you will fall in love with something, especially if you make a ton of money on it, and then you'll sit with this and it'll be dead money for a long time. So that's all she wrote.